Hi, and welcome to this week's market update.
Latest news.
Starting with the war in Ukraine, last week the United States and Ukraine finally signed the long-awaited mineral rights deal that would establish a joint investment fund for the reconstruction of Ukraine to be partly funded by revenues of future natural resource extraction. Now, win for Ukraine, the deal also adopted stronger language on the war with Russia itself, as well as maintaining complete ownership of those natural resources and infrastructure in the hands of Ukraine. On the other hand, Ukraine failed to secure the firm security guarantees that it had been after. Nonetheless, the deal was seen positively by markets and seen as a positive step in US-Ukraine relations, especially following that very contentious meeting at the White House earlier this year between President Trump and President Zelensky.
Weather.
Looking at the latest weather forecast, temperatures across most of Europe are expected to be below average over the next 7 to 10 days, with precipitation concentrated in the second half of this week and into early next week, mostly along Western and Southern Europe. Lastly, in terms of average wind speeds, Europe is expected to continue to see below average wind speeds across the continent.
Macroeconomics.
In a surprising turn, the US economy contracted in the first quarter of 2025, with US GDP decreasing 0.7% quarter over quarter. This is in stark contrast with the robust growth that the US economy had been seeing through the end of 2024. Most analysts are attributing the contraction in the US economy to the tariff announcement by President Trump at the beginning of April. It is too early to tell if the poor performance of the US economy will continue in the coming months, as much will hinge on whether the trade wars persist or if there is some negotiated settlement to those tariffs. In terms of PMI figures, the manufacturing sector across most countries remained relatively stable throughout April, while the service industry there, particularly in the US, saw a sharper drop, with the PMI dropping from a little over 54 to just over 51 points.
Crude oil and LPG.
Global crude oil prices continue to see a bearish price evolution over the past week, with the July 25 product seeing decreases of a further 7% week over week, with the frontier pricing seeing a drop of around 4.8% on the week. This continued the decreases that we had been seeing over the last few weeks, largely driven by the expectations of slower economic growth globally throughout the rest of this year as a result of the trade wars initiated by the United States. On top of the negative expectations for oil demand moving forward, the supply outlook has increased, particularly given the announcement by OPEC Plus that it would be increasing production quotas starting this June.
Natural gas.
Looking at natural gas markets in Europe, I'm focusing on the TTF price evolution as a reference for European gas pricing. We see an uptick in the market over the past week. For the front quarter, for example, we see an increase of 1.8%, with the gains increasing as we move along the curve, with the Cal 26 and Cal 27 products, for example, seeing increases of around 4% each. The upward movement in the market appears to be in part driven by some renewed optimism that the ongoing trade wars will be negotiated away in the coming weeks or months, and as a result will not have a lasting negative economic impact to the European economy. Additionally, we are seeing the lower demand for LNG globally, particularly from Asia, reducing price competition with Asian markets, and as a result, bringing some downward pressure on European gas pricing accordingly. Moving on to the fundamentals, European gas storage levels have continued to increase over the past week, pushing overall storage levels above 40% and reducing the deficit versus the average from 2012, and particularly versus last year, which, as we can see here, has narrowed from a little over 26% earlier in April to just around 22% as of the end of last week. Looking at the storage levels on a country level, there we certainly see the impact that the colder winter has had, with countries further up north seeing storage levels below the European average, and then countries further in the south, particularly looking at France, Italy, and the Iberian Peninsula, with above average storage levels. Looking at the injection rate over the past week, we note that it is near the highest levels we've seen since at least 2012, and noticeably higher than both last year's levels and the average since 2012. Moving on to the total supply and demand outlook, there we note a slight drop in total supply, in part due to a decrease in both Norwegian gas flows and in LNG sendouts, while overall demand for natural gas in Europe has seen even sharper decreases, pushing total demand to the lowest level since at least 2019. The European gas supply mix remains largely unchanged over the past week. And taking a closer look at that supply mix, we do note that decrease in Norwegian gas flows, particularly over the last few days, due to some additional maintenance needs there. And then when we look at LNG sendouts there, we note the decrease in sendouts very much as a response to the decrease in total demand across Europe. We look at the global LNG export destinations. We have noted that U.S. LNG exports have shifted cargoes from Europe towards Asia, in part due to the lower demand coming out of Europe over the last few weeks, but also a reflection of the changing economics with Asian natural gas pricing at a higher level than those of Europe. Lastly, looking at the investment fund positions for TTF futures, we see a continued decrease in the net long positions, largely driven by the continued uncertainty, particularly over the economic outlook for Europe, and as a result on how that will impact gas consumption and gas pricing overall.
Coal.
Looking at the price evolution of coal, we see a similar evolution as with natural gas, with pricing increasing over the past week for the frontier there, with the API4 index, for example, seeing an increase of around 4.4%.
EU and UK emission allowances.
In terms of emission allowances, there we also have seen an uptick in the market over the past week, with the European allowance pricing increasing around 3.5% on the week and around 8% over the last month. The main drivers of the increases here are certainly some of the higher natural gas consumption that we've seen, but more directly driven by some renewed optimism regarding the potential negotiated end to the ongoing trade war between the US and Europe, potentially leading to a less negative impact to the European economy, although that is yet to be seen. Over in the UK, we continue to see the ongoing discussions of recoupling the UK and European markets, adding support to prices on top of the similar factors that are impacting the European market there. In terms of power sector emissions, there we are seeing those emissions on the European side of things remaining near the lowest levels we've seen since at least 2019, owing to the strong renewable power generation, as we'll see later. And the expectation is that as we move through the summer, the increase in solar power output in particular will continue to keep overall emissions from the power sector at a lower level than previous years. Lastly, looking at the investment fund positions on the allowance markets, there we note European allowance futures positions being practically at zero for net long positions following the decrease that we've seen throughout this year, while over in the UK, we continue to see those net long positions at record highs there.
Electricity.
Looking at electricity prices and looking at the German power market as a reference for European pricing, there we see a similar evolution as with natural gas, with pricing increasing over the past week, with the increases being more acutely felt for the frontier and than in the shorter term. When we look at the power markets across Europe, we see that they are mostly following a similar price evolution as the German power market, with pricing in France and Spain seeing slightly more modest increases as a result of their lower share of natural gas-fired power generation. Looking at total demand and residual load, in line with the decrease that we saw with natural gas demand, we've seen a similar decrease in overall power consumption in Europe, largely driven by more favorable weather conditions. Looking at the electricity supply mix, what we note is certainly the high share of nuclear power generation compared to what we saw over the past year, but also the increasing share of both solar and hydropower generation over the last week. Starting with nuclear power generation, there we saw a decrease across Europe, largely driven by additional maintenance needs across the French nuclear fleet, reducing output from that country. In terms of renewable and fossil fuel power generation, we did see a slight decrease in renewable power output over the past week, but we've seen, as you can see here, a larger drop in fossil fuel power generation in line with what we've seen last year. When we look at the renewable generation output, while we note most technologies being very much in line with the average of 2019 through 24, on the bottom left, you can see solar power generation continuing to push new record highs in terms of output. Overall, wind and solar power generation remained somewhat below that of last year, mainly due to the underwhelming wind power generation, but nonetheless, solar power output continues to reach record highs and is expected to continue to do so throughout this summer. Lastly, looking at fossil and biomass generation, there we see those decreases that we're seeing over the past week, in part driven by those decreases in total demand and the improved solar power output. Looking at the hydro reservoir levels across Europe, there we note the much improved levels, particularly in Nordics and in the Iberian Peninsula, which are also having a bearish impact in pricing in those regions. Lastly, looking at the European guarantees of origin pricing, we see there was a bearish price evolution over the past week, with pricing decreasing noticeably over the past week across technologies and across the 2025 and 26 production years. That covers this week's market update. Thank you for joining.